I was recently asked, what's the secret to successful property investing? I'm going to tell you my answer in today's show. I'm also going to answer a question about what's a better investment, property or shares. And I'm going to let you into a secret about the real cost of financial freedom. So welcome to this week's episode of the Michael Yardney podcast, particularly to all the new listeners who join us every week. And thank you so much for coming back if you're already an established subscriber.
Welcome to the Michael Yardney podcast, where each week you will learn a number of new ideas regarding success, property investment and money in around 30 minutes. Our show is brought to you by Metropole, who specialise in helping you grow, protect and pass on your wealth through strategic property advice. Now here's your host, Michael Yardney, Australia's most trusted property commentator, who has once again been voted our leading expert in wealth creation. That's the fifth time he's won a similar award in the last 7 years.
Since you're listening to my podcast, I assume you're after more success, whether it's in property investment, in life, in general, in business. And I'm going to share 3 things with you today that will help you achieve that. The first one is answering Trevor's question of the secrets of success of property investing. And my answer probably will be a bit different to what you expect. And then I'm going to share with you a prolonged mindset message this week about the real cost of financial freedom. Some of the things that people don't tell you, but that's what we're all after, isn't it? More choices in life. It's not necessarily the money, but the choices that the money or the property portfolio or the business is going to give us. I hope you're going to get some lessons from what I'm about to share. And then I'm going to answer a question that was recently sent in on the website, but it's such a common question investors are asking. What's a better investment, property or shares? And why am I so biased towards property? So I've got lots for you. So thanks again for joining us for this week's Michael Yardney podcast. Trevor, a client, recently asked me, Michael, what's the secret to successful property investment? He said, what did you do differently to the average investor to build your wealth? Now, I think I disappointed him when I told him that there's no real secret. Successful investors just follow a system, one that's rooted in the real world and one that's stood the test of time in changing markets. So when Trevor asked for more details, I explained that I use a top-down approach. And I said this starts by examining the macro factors affecting our property markets and our economy, and then drilling down to a micro level. I said I start with the big picture, the macroeconomic environment. How's the economy going? How's the Australian economy going? How's the world's economy going? And then I look at the states' economies, where each state is in its own economic and property cycle. And then I look for a state which is going to outperform the averages in the long term, because it's economic growth that leads to jobs growth, which leads to wages growth and population growth, which drives our property markets. So I only invest in the big capital cities, I explained to him, rather than in regional areas, because 80% of the economy, 80% of our population is in the big capital cities, and in fact the vast majority of it is in the 3 big capital cities on our east coast. And then I explained that within each state, I look for the suburbs that are going to outperform with regard to capital growth. And I told him it's all about demographics. You see, some suburbs are going to be outperforming because the people in them have got high disposable incomes. So I look for areas where owner-occupiers want to live because of lifestyle choices, and where they can afford to and are prepared to pay a premium to live there because they got higher disposable incomes. So I look for aspirational suburbs, suburbs where people aspire to live there, or gentrifying areas because, again, people aspire to live there, and as they improve the areas, as they renovate the old rundown places, they push up property values around them. So we're working from the top down, the macroeconomic, to the right state, to the right suburbs, and then within those suburbs I look for the right location, because you know it yourself in your own suburb. Some streets, some nice streets, some tree-lined streets, some livable streets will always outperform others. And in those streets, some properties will outperform others. Look, I know in Sydney there's some streets where on the one side of the street, the houses have got magnificent views of the water and the Sydney Harbour Bridge. And on the other side of the street, the houses have got magnificent views of the houses on the good side of the street that have got views of the Harbour Bridge. So you've got to understand your market. Then you've got to look for the right property in that location, one that suits the local demographic. And finally, you choose price. When you choose a property, you've got to buy at the right price. But I'm not saying a cheap property. There'll always be cheap properties around in secondary locations. I mean, a right property at a good price. You know what they say. Price is what you pay. Value is what you get. Cheap properties, secondary properties will always be cheap properties. There'll always be secondary properties. So Trevor said, okay, well, how do you know how to find the right property now that you drill down the location? And I explained to him my 6-stranded strategic approach. First of all, the sort of properties I look for are ones that appeal to owner-occupiers. Not that I plan to sell the property, but because owner-occupiers are going to buy those similar properties and push up local real estate values. Now, this is particularly important at this stage of the property cycle where investors are not as abundant as they were before. So owner-occupied areas are the sort that are much more stable. Suburbs which have a larger propensity of investors are the ones that fluctuate in value more because investors wax and wane depending upon how the cycle's going about, how much property money they can get to buy properties. So I'd be looking for areas that have got large percentage of owner-occupiers, and then, of course, the sort of property that would appeal to those owner-occupiers. The next strand of my 6-stranded strategic approach is to buy a property below its intrinsic value, and that's why I avoid new and off-the-plan properties which come at a premium. And I look for properties with a high land-to-asset ratio. Now, that doesn't necessarily mean a large block of land. I'm looking for where the land component makes a significant part of the asset value. And then I look for buying those properties in an area that's got a long, strong history of capital growth, but of course is going to continue to outperform the averages. I've already explained that. And it's all related to the demographics that are there. See, in the last census, wages over the census period, wages didn't go up that much. But in some municipalities, wages went up much, much more than the average for that state. What that means is those suburbs where wages go up more, people have higher disposable income. And they're the areas where I like buying because they're the areas where people can afford to buy properties, renovate their properties, improve the area, improve the local economics. In general, they're closer to the CBD, closer to the water, and unfortunately, the way the world works is the poorer people and the working class and the blue-collar workers are going to be further and further away from the CBD. The rich just don't like to travel, so they're going to pay a premium to live close, pushing out other people. Interestingly, if you think about it, it's in those outer suburbs where wages don't go up as much, and it's also in those outer suburbs that maybe artificial intelligence and robots and all this technological change we're having are going to take over jobs, maybe not as much in those areas where more educated people tend to live. Now, I also look for a property with a twist, something a bit different, something unique, something special, something scarce about it. And then I always like properties in which I can manufacture capital growth. Even if you don't do the renovations or the redevelopment or the refurbishment straight away, you've got that potential. So rather than waiting for the market to do the heavy lifting, now that we're in a period of lower capital growth, you can manufacture some of your own capital growth. I've found by following my 6-stranded strategic approach, you minimise your risks and you maximise your upside. Now remember, as I've often said, the location of the property is going to do 80% of the heavy lifting. So location is critical. When you look for an investment, I explained to Trevor, you've got 3 things to play with. You've got your budget, and the banks tend to set that for you. You've got location, you don't compromise on that, so then you've got to buy the best property you can in that location. And each strand of my 6-stranded approach represents a way of making money from property, and combining all of them is a powerful way of putting the odds in your favour. So if one strand lets you down, you've got 2 or 3 others supporting your property's performance. When you look at it this way, buying a property strategically takes a lot of time, effort and research, and that's something most investors never do. They don't get the perspective that you need to be able to do that research. So you can do searching of properties and you can research a lot of information on the internet. What you can't get without years of experience is the on-the-ground perspective. And I guess that's why a lot of clients use people like the team at Metropole to help them. It gives you an unfair advantage. It's impertinent to think you can learn from the internet what it's taken our team $3 billion worth of transactions to learn. So you can get a lot of information on the internet. You can get it from reading books. You can get it from magazines. But what you can't get is that experience. So Trevor then asked me, Michael, how do I conduct the research that I've got to do first? He probably thought I'd quote various online research portals. And while these are great resources, that's not the answer I gave Trevor. Think about it. Most research data tells us what's happened in the past. What I'm looking for are what I call leading indicators, not lagging indicators. I look for indicators that are going to show me, predict, I guess, what's going to happen in the future. So I pay attention to things like economic forecasts, population growth, consumer confidence, employment growth, finance approval trends. But more importantly, I explained to Trevor that I recognise the destiny of our property markets are going to be determined by two main things. Demographics, how many of us there are, how many of us are going to be living where we want to be living, how we want to live, and also the wealth of the nation, the fact that we can afford to buy properties. So I look for suburbs where people are able to and prepared to pay a premium to live there, as I said, because they've got these high disposable incomes. Then I get to know the real estate markets in those areas by analysing market trends, supply and demand, auction clearance rates, vendors asking prices, days on market. And most importantly, or not me anymore, but my team inspect lots and lots of properties and track their sales results. So I said to Trevor, you see, there's really no secret to successful property investing. We're coming up for our short break, but please stick around because I've got two great messages for you afterwards. I'm going to discuss with you the real cost of financial freedom, and whether you're a property investor, a business person, an entrepreneur, this is going to apply to you. And then I'm going to answer a question that was left on our website about property or shares. What's a better investment? You know my preferences, but I'm going to explain why in a short answer. Well, 2019 is going to be a really interesting year in property, isn't it? So many things are going to affect our property markets, things we haven't got control of, things like an upcoming election, the Haynes Royal Commission, APRA, banks, finance. But there are some lessons we can learn from the past on how to invest in uncertain times. So while the causes of uncertainty may be different to the past, the lessons, the rules that we've learned from the past are really much the same. And that's why I want to invite you to join me and a group of other experts who've traded through uncertain times successfully, who've invested in difficult times and can teach you those lessons. I'm inviting you to my once a year property and economic market updates that I'm holding in Brisbane, Sydney and Melbourne, just around the corner in March and April. And you really, really must attend this year because the winds have changed, and if you don't set your sails differently, you're going to be blown off course. So we're going to teach you a bit about the pitfalls. We're going to teach you a bit about what to look out for. We're going to teach you where the opportunities are. Because as you know from my podcast, there's just not one property market. There's multiple markets around Australia, and there are some areas of opportunity. These more uncertain times are the times in previous cycles when generational money has been made. People have set themselves up for the next stage of the cycle that has set them up almost for life. So please go to propertymarketupdate.com.au. And because you're a subscriber to my podcast, I'm even giving it away for free so you and a friend can come and join me and learn about how to become a more successful investor by protecting yourself, by taking care of opportunities, what to do, what not to do. propertymarketupdate.com.au, and if you use the coupon code podcast, you'll be coming as my guest.
Now here's Michael's mindset message. Remember, a change in your thinking will lead to a change in your life.
Now, one of the reasons you're probably listening to this podcast is because, amongst other things, you want more financial freedom. So allow me to let you into a secret. There isn't anything free about financial freedom. In fact, it comes at a great cost, and a cost that for too many people, they're just not willing to pay. And in my mind, there are two components to this cost. One is sacrifice. You're going to have to be willing to permanently forego a number of things to achieve your goal. And the other is delayed gratification. In other words, you're going to have to be willing to temporarily forego things until you've achieved certain goals. So let's look at these two components of the cost of financial freedom. Number one, sacrifice. Look, if you think about it, elite athletes, they've got the diligence, the determination that bring them to mastering their minds and their bodies. They can't afford to cheat on their diet or their training regime and still expect to outperform. It's interesting, a number of years ago, the daughter of one of our good friends was training to be an Olympic athlete, and while I was comfortable in bed at night, she was out rowing early in the morning. She was doing it late at night when other people were already home watching TV, when other teenagers were having fun going out. She invested in her time. She gave up sacrifices. She was comfortable having the short-term pain because she got the long-term gain. And interestingly, it's the same with elite financial management. You can't just cheat and spend a little bit here and there thinking it won't matter, or use debt, your credit card, to pay for luxuries you can't afford today and not worry about what's going to happen later. So you've got to learn sacrifice if you want to become financially free. It's one of the costs. And the other cost is delayed gratification. Look, we live in a world of consumption where people want immediate gratification. You know, we want the latest and greatest gadgets and products as soon as they hit the shelf. Think about what happens with Apple every year. That ridiculously long lines of people in queue for the first editions of the updated iPhone. And when it comes to money management and becoming rich, patience and delayed gratification also make all the difference. Patient people are more likely to save their pennies than seek an easy and expensive credit card debt because they're happy to wait for their new car or their big TV. See, they don't think they've got to have it all yesterday. Now, one of the common rich habits that I've written about in my book, Rich Habits, Poor Habits, I hope you've got a copy of it. If not, go to richhabitspoorhabits.com, get a copy of it. It's, I think, the most powerful book I've written. Anyway, one of the common habits I've found amongst successful people is their ability to delay gratification. Successful people possess higher patience and an aptitude to postpone the enjoyment of their work. They've got an ability to work hard to accomplish goals, even if they're not going to be achieved for a long time. So learning to delay gratification rather than seeking immediate satisfaction is, in my mind, critical, essential for success, particularly when it comes to things like investing, like business, like making money. Yet it's not easy to change those ingrained habits and approaches to life that you've probably been practicing since childhood. But once you're aware of the importance of the concept of delayed gratification, it's entirely easy to do. Look, you've got to start with small alterations to the way you think, to the things that you do, by acknowledging these habits. Remember, if it comes too easily, chances are you're going to lose it easily again too. All good things take time. You've heard me say it so often. Warren Buffett actually said it. I just repeated it. Wealth is the transfer of money from the impatient to the patient. So what does delayed gratification mean? Now, if you're wondering what I'm talking about, let me explain. The definition of delayed gratification or deferred gratification is the ability to resist the temptation for an immediate reward and therefore wait for a later reward. The later reward is generally much larger than the immediate one, and that's why it's worth waiting for. Research into the ability of delayed gratification shows that there are a number of other positive outcomes of this skill. It includes more academic success, physical success, psychological health, social competence. Now, similarly, a person's ability to delay gratification relates to other skills such as patience, impulse and self-control and willpower, and all of these are an important part of success. So if we think about the rich and successful, one of their key habits is the ability to delay the small instant rewards for a later, much more generous one. But we need to remember this skill isn't natural for most people, and that's why you and I, to a degree, are having trouble with it. See, as humans, we're hardwired to instant gratification. We love it. while evolution has made us that way long before our modern monetary system came about, unfortunately, the desire for delayed gratification doesn't help us when we're trying to become wealthy. In fact, it hurts us. And that's one of the reasons many high-income earners are not rich. You'll often find they earn more money, so they spend more, and they end up on this treadmill. When they spend more, they earn more because they've got to try and support a lifestyle that's got little or no enduring value. But it's got a high cost to maintain. Typically, they spend things on big houses, fancy cars, impressive vacations. They live a life of instant gratification where they live in a peer group of other people who are also big spenders and also having a difficulty maintaining their lifestyle. You know what we call that, don't you? That's the rat race. On the other hand, when it comes to delayed gratification, when it comes to the latest gadget or fad, most people have got no self-control. This is even worse in this new technological world where we all want to have instant, all sorts of things. We've got easy access to instant money, of course. All this has happened because we've got these credit cards that we can spend on straight away. It didn't happen before. When there weren't credit cards, people had to save up, if you think about it. But today, people can use their credit cards for impulse purchases that in reality, they got no way of repaying anytime soon. Unfortunately, this type of mindset leads them to financial ruin. Now, if you're listening to this and it sort of relates to you, it's time for you to be honest with yourself. Are you a slave to instant gratification? If so, there are a number of strategies that you can use to break the cycle. But first, you must recognise that this is one of your poor habits. So let me be clear, consumer debt is never okay. Using your credit card for impulse purchases or taking on unnecessary debt for non-appreciating assets such as cars or latest technology things, or a personal loan for a holiday, that's never a good idea. Too many people see the limit on their credit card as their money, and it's not their money. So think about it. When you take on consumer debt, it involves using dollars you're hopefully going to earn in the future for current expenses or splurges for today and paying the bank interest for the privilege of using their money. What this generally means is the bargain that you paid for today is likely to cost you much, much more over the long run because you're paying credit for it. So one of the key differences between people with consumer debt and those without is, everything else being equal, that the person with no consumer debt has mastered delayed gratification, while the person with consumer debt has not. Do you know somebody like that? Somebody reasonably close to you? Look, in the simplest form, it's the ability to wait 15 minutes to get 2 marshmallows instead of 1 marshmallow today. That's delayed gratification. The ability to wait and buy something after you've saved for the item rather than impulsively purchasing something as soon as you want it, that's delayed gratification. The ability to invest money today so that when you retire, you're going to have the lifestyle of financial freedom you want, that's delayed gratification. So you're probably thinking, well, that's all interesting, Michael. How do I learn delayed gratification? Well, like I said, it isn't easy, but there are some skills you can put in your toolkit to help you. So here's the first one. Why not write down a list of the money goals that you've got and put them somewhere that you can see them every day? And look, another idea may actually be to tell somebody about these goals, perhaps a mentor who can help you become accountable. So have those there and know those goals so that anything that you're doing that is actually taking you further away from them, you're going to think, hey, I shouldn't be doing that. Now, another tip could be every time you're tempted to purchase something, consider whether it's a want or a need. If it's a want, such as a new suit, new handbags, some new clothes, then delay it for at least 24 hours before deciding whether you want to buy it. Most of the time, that 24-hour period will be enough time for you to see that you don't need it at all. If you're going to buy a doodad online, how about putting it in the shopping cart, but don't click the checkout button. Instead, come back in 24 hours, and if you still need it, then buy the item. You'll actually be surprised how often the desire disappears after that 24 hours. So for more expensive items, though, maybe you should actually leave that a little bit longer than 24 hours. And the last strategy I'd like to share with you is get some advice from somebody much older than you and ask them what they would have done differently with money were they your age. It's likely they're going to share with you that things you probably never thought about. And in my experience, they're probably going to disclose that they wish they started saving earlier, they wish they started investing earlier, they wish they hadn't spent their money on things that they didn't need at the time. So the message I'm trying to give across to you today is financial freedom comes at a cost. It comes at a cost of sacrifice, giving up things now for the future, and it comes at the cost of delayed gratification. But in my mind, there's no doubt that the cost is worth the benefit. Because what's the alternative? Think about it. In 10, 15 years' time, you're going to have a future. It's going to be an ideal future of financial independence. It could be an okay future with a little bit of income. It could be a crisis where you really are not going to be able to stop working. You're going to have to keep working. So your choice. Pay now or pay later. Today I'm going to answer a question from Andrea Barker from Brunswick West in Victoria. Thanks for sending in your question, Andrea, and you're going to get a book and a DVD set in the mail. Anybody who leaves a question at the bottom of any of my podcasts at michaelyardneypodcast.com, and if I read it out and answer it, I'm going to send you a gift as well. So leave your details, even though they won't be published on the website. And today's question says, to date, I've been very focused on property investment. Michael, what's your view about share trading as a form of more balanced investment portfolio? Well, thanks for the question, Andrea. And I guess my question to you is, why do you want a balanced portfolio? If you're talking about diversification, we've discussed this in previous podcasts where diversification leads to averageness. So I guess my question back to you is, what are you trying to achieve? And if it's the same as most property investors, what you're wanting to do, I guess, is get a level of financial freedom. You're trying to get a level of independence of choices in life, of going to work because you want to, not because you have to. And the only way you're going to do that is by getting income. And the only way you're going to get income from whether it's shares or businesses or property is to build a substantial asset base. So it comes in 3 stages. The first stage is build your asset base. The next stage then is to slowly lower your loan to value ratios and then live off your properties, whether it's off the rent or off equity or whichever way you want. So I'm biased towards property. But I'm not biased because it's property. I'm biased because of the results I get. I've tried share trading. I'm no good at it. I know some people are. My good friend Louise Bedford is very good at it. But most people who are good at one thing aren't necessarily able to translate that to another field. So I'm not biased to an asset class. I'm biased to getting an outcome, a result. If I could get the same result out of shares, I would be investing in shares. But in general, the share market is more volatile. In general, the share market hasn't got the capital growth that properties have. And in general, you can't leverage against shares like you can against property. So yes, I'm biased to property because of the results I get, the stability, the fact that it's not as volatile. But I'm even more biased, actually. I'm biased towards capital city property. I'm biased to certain suburbs within the capital cities. Why capital city properties? Well, 80% of us living in capital cities and more are going to in the future. Why the big capital cities? Because that's where the jobs are going to be created. The statistics suggest that in the next 5 years, 35% of the new jobs are going to be created in Sydney, 30% in Melbourne. That means 2/3 of all the jobs are going to be created in those capital cities. That's why I'm biased to invest in particular suburbs in those capital cities. So I don't see a benefit, Andrea, of balancing your portfolio. I believe you should become an expert, specialise in something, and rather than balancing it, which leads to averageness, look for one that's going to outperform. That's the only way you're going to get out of the rat race, Andrea. We've covered a lot in today's show, but there's one more thing I'd like to share with you, and it's a 5-star review from Chris Person from Auckland in New Zealand. And Chris said, I read Michael's book about 10 years ago and was impressed with his desire to help and educate with an honest, no-nonsense approach without bias, and is based on many years of experience. I really enjoy his podcast and I can understand why this man won so many awards. His integrity and the fact that he only wants to help you gain wealth is deeply appreciated. Sure, his business is educating and being a buyer's agent, but the level of transparency this man operates in is second to none, and the results he's achieved for others is outstanding. Thank you, Michael, for taking the high road. Thank you for giving, doing the right thing. It's a rare trait these days. Gee, Chris, that's a very special review. And you've really made my day by doing this. Because part of the reason I do this podcast is to give back. Yes, I am financially successful. I have achieved what I'm talking about. I have got skin in the game. I'm buying property still. I'm involved in the property market. And I'm enjoying helping other people by sharing the message. So thank you for recognising that and leaving that great review. And like for every review I read out, I'd love to say thank you by gifting you one of my books. So just email me at michael@metropole.com.au and tell me which book you'd like. Now, if you've got some benefit out of listening to today's show, why don't you pass the message on and help others as well? In any of the podcast apps, there's a share button. On iTunes, there's these three little dots down the bottom. You press one and you can share it. So why not tell a couple of friends about it? Share it on Twitter, Facebook, LinkedIn, Instagram. I don't care how, but let's get the message out so together we can educate more investors and help make the world a better place. Thanks for sharing the last half an hour with me, and I look forward to spending some time with you again this time next week.
Thanks for listening to this week's episode of the Michael Yardney podcast, which was brought to you by Metropole, who help their clients grow, protect and pass on their wealth through strategic property advice. If you got value from today's show, we'd really appreciate it if you would leave a review, and we'll read it out on a future show, and Michael will gift you one of his books as a way of saying thank you. Just go to michaelyardneypodcast.com/review and let us know what you think. If you don't already subscribe, head over to iTunes or your favourite Android app. You'll find us there as Michael Yardney Podcast. If you'd like to gain instant access to the show notes, head across to michaelyardneypodcast.com. Watch out for our show next week. You'll learn some new ideas about property investment, success and money in around 30 minutes.